Welcome back. The world's main oil producers, including Saudi Arabia and Russia, are likely to agree to cut output at a meeting on Thursday, although that will depend on the United States doing its share. A worldwide oil demand has dropped by as much as 30%, or about 30 million barrels per day, coinciding with moves by Saudi Arabia and Russia to flood markets with extra supply after an agreement on withholding output fell apart. A research analyst at the financial derivatives company, Dumebi Iyeke, joins us now to talk about the implications of all this. Good afternoon, Dumebi. It's good to
Good
have you here
afternoon,
with
BC.
us.
Thank you so much for having me.
So do you think that the postponed meeting of OPEC Plus now will help salvage the effect of the price war among the oil producers?
The truth of the matter is the oil markets received a significant improvement during the announcement of the meeting, and with the postponement of the meeting, oil prices also declined. So the effect of the postponement of the meeting and the price war are relatively the same, meaning that oil prices are having the same reaction by declining. However, this is not, or these events are not the significant or the fundamental problems causing oil prices to decline. Oil prices have been declining for the past at least 3 years, and this is because of the demand gap in the oil market currently, and we're having a supply glut. This is because oil production right now is relatively higher than the demand for oil in the market. We're seeing that, and that's why we've seen the response by OPEC trying to cut oil production from the various countries, reducing their quotas to ensure that oil production is not, oil supply is not significantly higher than the demand, so that oil prices don't keep declining. And all of these events combined with the COVID-19, are the things that have led to the decline in oil prices. So with all of these events coming into play, all of this interplays in the oil market, we've seen that oil prices have been declining. Really, the oil market is really under pressure, and when oil market is under pressure, we see the ripple effect in other markets like the commodities market, even in safe haven assets. So that's basically the current stay in the oil market right now.
Well, bringing things closer to us here
Yes.
now in Nigeria, of course, Nigeria is a price taker, and the oil cartel, of course, it depends
Yes.
on oil for almost 70% of its fiscal revenues. Now,
Yes.
what will be the impact of a collapse in these stocks on Nigeria's supplementary budget, which, of course, is predicated on the price of $30 per barrel?
Exactly. The truth of the matter still remains that if oil prices decline, if these stocks don't go in favor of an oil production cut to support oil prices, definitely Nigeria's supplementary budget, which is already a revised budget, will be revised again. We would see that reaction by the federal government. This is because oil prices, when they decline, our fiscal revenues will be badly hit. External reserves would also be hit, and proxies like the FAC allocation would also significantly decline. Our external reserves are currently at $34.98 billion, and if oil prices decline further, it will definitely decline again, and our import cover as well would also decline. So all of this would negatively affect Nigeria's ability to meet internal obligations, and would force the nation or force the federal government to go outwards, look outwards for revenue sources.
No, but what if there is an agreement to cut 10 to 15 million barrels of oil from global supply? Now, what do you think will be Nigeria's new quota, and what would this mean for Nigeria's hope of coming out of an inevitable recession in 2021, especially with what's happening with the COVID-19 pandemic?
The truth of the matter is it's highly unlikely that we might see this. It's highly unlikely that we might see a discord between or a discord within the OPEC cartel concerning cutting oil production. And this is because if they decide not to cut oil production, everyone will feel the pain, because the crash in oil prices will not only affect Nigeria, but affect other oil producing states. So bringing this back, what we'll see definitely is Nigeria will be, like I said earlier, would definitely be hit badly by this. And for the global supply of oil, we'll definitely see that there would have to be a resuscitation of global supply. Why? Because if oil production is not adequately resuscitated or adequately addressed, there would be a supply glut in the market. Nigeria would be badly affected, and right now we're trending on negative territory for GDP. I mean, our PMI, FBN PMI was recently released, and we're already in the contraction territory, and meaning that economic activities are significantly declining. And if this continues, Nigeria would, I mean, an economic recession is highly inevitable for the country. What Nigeria's new quota would be, we really can't say, because OPEC would have to be the one to establish the quota. But we would say that the quota would also be, reduced. And Nigeria is more production sensitive than price sensitive. So we can only hope that the increase in prices, if production cuts happens, would be enough to cushion the decline in oil production for the country.
We can only keep hope alive.
Exactly.
Jumebi Iyeke, research analyst at the Financial Derivatives Company. Thanks for coming on the program.
Thank you.
Let's turn now to South Africa, where the central bank has slashed its growth forecasts for the country, predicting the economy could shrink by as much as 4% in 2020 due to the coronavirus pandemic, which has forced the national lockdown and triggered 2 credit ratings downgrades. The bank also says growth is unlikely to exceed 1% in 2021. The job losses this year could reach 370,000, and business insolvencies would likely increase by 1,600. In its biannual monetary policy review, the SARB says South Africa's pre-existing macroeconomic vulnerabilities make it unrealistic to implement stimulus on the scale seen in the strongest advanced economies. Africa's most advanced economy was already on the ropes when the pandemic hit local shores, recording its second recession in 2 years in the final quarter of 2019, with data from 2020 already showing slack industrial and financial activity. Meanwhile, Standard Bank says it will consider guidance from South Africa's central bank asking lenders not to pay dividends in 2020 as the coronavirus outbreak disrupts economies around the world. The SARB's Prudential Authority had advised lenders on Monday not to pay dividends or bonuses due to the crisis, joining the Bank of England, European Central Bank, and others in asking banks to skip shareholder returns. Standard Bank says in a statement that the board fully recognizes the importance of dividends to the group owners, but also recognizes the need to support households and businesses amid the COVID-19 pandemic and the importance of ensuring the stability of the group in the short, medium, and long term. Away from South Africa now to Ghana, where the Republic Bank is asking the government to consider cutting tax rates to cushion the economy from the fallout of the coronavirus. The Accra-based lender advises the government to ease corporate income tax to 20% from 25% and give workers relief. Ghana's government has cut its forecast for economic growth this year to a 37-year low of 1.5%, with a partial lockdown underway. It's also trying to help small businesses while seeking to boost maximum borrowing levels and secure extra funds from the International Monetary Fund. The central bank has cut interest rates to an 8-year low and eased capital rules to free up money for lending and to increase liquidity. And in Kenya, leading telecom firms Safaricom and South Africa's Vodacom have announced the completion of the acquisition of the popular mobile money platform M-Pesa from Britain's Vodafone. In a joint statement, the firms explained that the acquisition of M-Pesa's brand products, development and support services from Vodafone was done through a newly created joint venture. The transaction, which was first announced in 2019, will accelerate M-Pesa's growth in Africa by giving both Vodacom and Safaricom full control of the M-Pesa brand, product development and support services, as well as the opportunity to expand M-Pesa into new African markets. And that's where we end today's program. Thank you for watching. I am BC Adebayo.